Okay, let's kick this off with a story. Imagine you're an airline pilot, Robert Thompson. You walk into a convenience store,
Right.
and almost instantly, this overwhelming sense of fear just hits you. A really primal
A
reaction,
gut feeling.
a deep one. And he just turns around and walks right back out. Minutes later, that store is robbed at gunpoint. An officer is shot.
Wow.
And it was only after the fact that he could piece it all together, what his brain picked up on.
Specific cues.
Yeah, a man in a heavy coat in the Florida heat, the clerk's intense focus, a car parked just a little too far from the curb. His subconscious saw it all.
That pilot's instant assessment, that's really the gap in our old understanding of markets. It prioritized survival, not rational thought.
And for decades, traditional finance was built on the complete opposite of that.
Completely. The efficient markets hypothesis, or EMH. It assumes investors are these perfectly rational actors, like supercomputers, Homo economicus.
It leaves absolutely no room for that fear factor. It assumes every single decision is optimal.
Exactly. And the tension between that flawless model and, the messy reality of human panic, it all came to a head in a really shocking way.
The Space Shuttle Challenger disaster, 1986.
That's the one. The shuttle exploded just 73 seconds after launch on January 28th.
I remember just the confusion afterward. NASA, they refused to speculate. And the official investigation, the Rogers Commission, that took 5 full months.
5 months of painstaking work to confirm the technical cause.
The defective O-rings, right. They became rigid in the cold. I remember Richard Feynman on TV dipping one in ice water to show everyone.
Yeah, a brilliant demonstration. But what's really fascinating here is the stock market.
How it reacted.
Maloney and Mullerin did the research. Within minutes of that explosion, the stock of Morton Vehicle, the contractor for the rocket boosters,
The ones with the O-rings.
right, their stock just plummeted. It dropped almost 12% before trading was halted. The order flow was just completely overwhelmed.
Wait, hold on. The market figured out that Morton Vehicle was the specific contractor responsible,
Within minutes.
while it took the best aerospace engineers in the world half a year.
That's the incredible speed of the wisdom of crowds. Information that wasn't public, certainly wasn't confirmed, was somehow priced in almost instantly.
But if the market was that smart, that fast, why did the official investigation still take 5 months? Doesn't that still point to a huge inefficiency, just on a different timeline?
And that is the core tension for our deep dive today. That instant wisdom of crowds runs head-on into the madness of mobs, which, we saw plain as day in the 2008 financial crisis.
So it's a Jekyll and Hyde market.
And it's not a glitch. It reflects our own nature. So our mission today is to explore the adaptive markets hypothesis, the AMH. It's a new story that tries to reconcile these two extremes.
It sees markets not as physics, but as biology.
Exactly, as a biological system where everything is driven by evolution and survival.
So let's start at the beginning then. Let's talk about the rational foundation that EMH was built on.
Well, the intellectual roots go way back, over a century. Louis Bachelier in 1900. He described stock price movements as being like Brownian motion, a pure random walk. He actually anticipated Einstein's work.
And his conclusion was pretty stark.
It was purely mathematical.
Yes.
You can't beat the market in the long run. It's statistically impossible. And that idea eventually led to Paul Samuelson and, most famously, Eugene Fama formalizing the EMH.
And Fama's big line became gospel. Prices fully reflect all available information. And they broke it down into 3 types of efficiency.
That's right. Weak, semi-strong, and strong.
So weak means past prices don't help.
Correct. Semi-strong means all public information, news, reports, everything is already in the price. And strong means even private insider information is reflected.
This framework basically told analysts they were wasting their time.
It really did. Whether you were looking at charts or company reports, a famous Fama study looked at stock splits and showed the price adjusted almost instantly to the news, which seemed to confirm the theory.
But this whole rational model, this Homo economicus robot, it has some really critical blind spots.
Yeah.
Especially when you get beyond known risk and into real uncertainty.
That is where the Ellsberg paradox just blows it apart.
Okay, walk us through it.
Imagine you have 2 urns, both with 100 balls inside. Urn 1 has 50 red and 50 black. The odds are known. That's risk.
Okay, a 50-50 shot.
Urn 2 also has 100 balls, but the mix of red and black is a complete unknown. That's uncertainty.
So mathematically speaking, the odds should be the same, right? You should treat them as equal.
The expected payoff is identical, but when you ask people to bet, even, highly trained MBA students, They will consistently bid less on the second earn, the uncertain one.
They prefer the known risk over the ambiguity.
A deep human preference. So the key insight here isn't just that we're risk averse, it's that uncertainty itself cripples rational decision making in a way that risk just doesn't.
And that's the crack where EMH starts to fail.
A crack that turns into a canyon when you start talking about losses.
And this is where the pilot's fear factor comes roaring back. We see that classic behavioral bias, loss aversion.
Right. The tendency to become risk-seeking when you're facing a loss, but risk-averse when you're looking at a gain.
Wall Street has that old saying, cut your losses and ride your gains.
Sensible advice that our biology fights against every step of the way. You know that pit in your stomach when your portfolio is down? That urge to just hold on, or even worse, double down. That's pure instinct taking over.
And the rogue trader stories, Kerfield, Nick Leeson, that's just loss aversion on steroids.
Exactly. They hide a small loss. They reach this psychological Rubicon where admitting failure just isn't an option. And then they make a panicked Hail Mary trade hoping to erase it all.
That twisted logic turns a small mistake into a multi-billion-dollar catastrophe. The trader stops being Homo economicus and starts acting like a cornered animal.
And when you have predictable human failures causing billions in losses, the market was just begging for someone to remove instinct from the equation entirely.
Which is why the revenge of the nerds was inevitable. The quants.
The mathematician economists, right, speaking in alpha, beta, and sigma.
So where did they first get their footing?
The birth of the quants really came from observing anomalies in the market. Specifically, at Morgan Stanley, traders noticed that huge block trades created these brief but predictable ripples.
And David Shaw saw an opportunity there.
He did. He realized you could use complex quantitative models to systematically find and exploit these little short-lived anomalies.
But his genius wasn't just the math, right? It was how he structured his firm, D.E. Shaw.
That was the key. He modeled it after an academic research lab. He'd use profits to fund what were essentially randomized controlled trials to test new models, always hunting for the next edge.
And in doing so, he saw the core principle of adaptive markets in action.
In real time, he saw that the anomalies they found, the effects they exploited, they tended to disappear over time. The strategies would just stop working.
Because the market, the other participants, were adapting. It wasn't about finding one permanent glitch. It was about adapting faster than everyone else.
Which brings us right to the heart of the adaptive markets hypothesis. The core idea is that we are not rational actors with a few bugs.
We are a system of quirks.
A system of quirks that evolved for one purpose? Survival.
So the behavior that looks completely irrational in finance, like panic selling or chasing a bubble, it's just an old adaptation in a new, unfamiliar environment.
I love the great white shark analogy from the book. In the ocean, it's a perfect predator, unbelievably efficient.
But if you drop that same shark on a sandy beach,
Its thrashing looks silly, irrational, self-destructive. It's perfectly adapted for the deep sea, not for dry land. And for our brains, the modern financial world is dry land.
what's really counterintuitive here is the role of emotion. We're taught to think of emotion as the enemy of rational thought.
But the source material gives us this incredible case of a patient named Elliot who had frontal lobe damage. He was still witty, smart, did fine on logic tests.
But he lost the ability to feel emotion, even mild emotion, and it made him incapable of making rational decisions.
I know, it sounds crazy. Why would that happen?
If he can still do the logic, why did his decision-making just fall apart?
The neurologist Antonio Damasio figured it out. Emotion provides the internal reward and punishment system you need for any cost-benefit analysis.
So if you have two logical options, how do you choose if neither one gives you a spark of preference or a gut feeling?
You can't. To Elliot, everything looked the same. He was paralyzed. Our emotions don't destroy rationality, they actually make it possible.
So our brains use these mental shortcuts, these heuristics, to deal with all this complexity. But the shortcuts can lead to some really weird, predictable irrationality, like probability matching.
This one is a deep, deep evolutionary insight.
It seems so counterintuitive. Why would any creature deliberately choose a strategy that's less profitable?
Okay, think of it like this. The psychic hotline game. You predict A or B. A shows up 75% of the time. B shows up 25%.
Yeah.
Now, to maximize your personal score, the best strategy, the deterministic one, is to just choose A every single time. You'll be right 75% of the time.
Makes sense, but people don't do that.
Not at all. And it's not just people. Primates, pigeons, fish, even ants. They all tend to match the frequency. They choose A about 75% of the time and B about 25% of the time.
They're deliberately sacrificing their own best outcome.
It seems that way. The explanation comes from evolutionary ecology using a model of tribbles.
The fuzzy sci-fi creatures,
Yeah.
okay?
So they're looking for a place to nest. The weather is sunshine 75% of the time and rain 25%. They can nest in the valley, which is high reward in the sun, or on the plateau, which is low reward but safe from rain.
The optimizers, the ones who always choose the best odds, will always go to the valley.
The deterministic tribbles, yes. They'll do great when the sun is out, but the first time it rains, that whole group gets wiped out. It's a single point of failure.
But the probability matchers, the ones who hedge their bets, 75% in the valley, 25% on the plateau, they're individually less successful in any single year.
Precisely. But here's the critical finding. Probability matching maximizes the growth rate of the group over the long haul. It ensures the population survives.
Slow and steady wins the race.
For the population, yes. Our so-called irrational behavior is often just a heuristic that evolves to keep the group alive, not to maximize your individual 401k.
That reframes everything. So the AMH lets us see financial markets as these constantly evolving ecosystems.
And speaking of ecosystems, the analogy of hedge funds as Darwin's finches is just perfect. They're on this archipelago constantly adapting their strategies.
We have specialists like Soros doing global macro or Paulson focusing on specific business events.
It's adaptive radiation, different strategies filling different niches.
And for anyone listening, the hedging in hedge fund, it just means they use short positions betting against stocks to try to offset losses on their long positions. It's about being less sensitive to the whole market swinging around.
But these tightly coupled ecosystems can fail spectacularly, which brings us to the quant meltdown of August 2007.
A huge wake-up call for the quant world. These super complex mathematical strategies just suddenly fell apart.
Many of them were based on something called statistical arbitrage, or StatArb.
Okay, let's define that. What is StatArb?
It's basically a bet that things will snap back to normal. So if, historically, the price of stock X and stock Y move together, and then suddenly X drops while Y stays flat...
The algorithm bets that X will eventually catch up to Y again.
Exactly. It's mean reversion in action. It relies on a predictable pattern.
So what broke in August 2007?
The problem was something called a crowded trade. A lot of quant funds, all working independently but using the same basic data and assumptions, ended up with very similar portfolios.
So when the losses started, a simple mean reversion strategy lost over 3% on August 9th. They all ran for the exits at the same time.
They all tried to cut risk and unwind those positions simultaneously.
And if everyone is trying to sell the exact same stuff at the exact same time,
liquidity just vanishes. And that triggered a positive feedback loop, like a microphone squeal. It amplified the losses, which forced even healthy funds to sell more, driving prices down even further. Everyone was trapped in this catastrophic spiral.
a failure of the ecosystem itself. And when a crisis like that hits, the rest of us struggle to explain it because of the tyranny of complexity.
Complexity is often just a polite way of saying ignorance. And the people who master it become the high priests of complex systems, and everyone else is just left looking for a simple story.
And that vacuum gets filled by these simple, sticky, but false narratives. Because they fit our existing heuristics. We saw that a lot after 2008.
Oh, absolutely. Think about the myth that the SEC's 2004 leverage rule change directly caused the crisis.
The story being that it allowed Wall Street to take on way more debt.
Right, and that narrative greedy executives responding to deregulation, it just stuck. It's a simple, satisfying story.
Because we're adapted to prefer a good story, people respond to incentives over a bunch of dense, complicated facts that challenge that.
Exactly. Even though the facts from the GAO and others showed that those big firms already had incredibly high debt ratios well before 2004, the simple story about greed just beat the complex facts about pre-existing leverage.
Which brings us to financial morality, which is also an evolutionary adaptation for cooperation. We see this preference for fairness even in chimps playing the ultimatum game.
Our built-in moral compass screams, "Emmy, hurt you," when we see direct personal harm.
But modern finance often lacks that personal connection. It's psychologically easier to accept a profitable but, predatory trade when it's just numbers on a screen.
That "Emmy, hurt you" reaction doesn't get triggered.
And yet the entire system runs on this virtuous circle of trust. Trillions of dollars moving through automated, dependable transactions every day.
And any system built on trust is also open to abuse. I mean, fractional reserve banking kind of operates like a giant regulated Ponzi scheme.
Yeah.
But when trust is misplaced, like with Madoff, where it was all based on one charismatic person, the failure is just devastating.
Okay, so let's synthesize this. The AMH tells us markets are evolving ecosystems. Efficiency isn't some fixed state, it's a continuum. And success is just about adapting your heuristics faster than the environment changes.
And the positive side of this evolutionary view is huge. Warren Buffett called derivatives financial weapons of mass destruction, but we can turn that around.
The same science gives you WMDs or nuclear power.
Exactly. We can use financial engineering to solve enormous social problems. Take the cancer cures megafund concept. Drug development is incredibly risky for one investor. A tiny chance of a huge payoff after a decade.
Too risky for most.
But if you use securitization, the same techniques from the financial crisis, you can bundle, say, 150 of these high-risk projects into one fund.
And what does that bundling do?
It completely changes the risk-reward profile. You turn 150 individual long shots into one investment vehicle with a high probability of a good return. You can fuel innovation. The problem was never the tools, it was how they were used. The tools are neutral.
That is a future worth investing in. So today's AI, it's incredible at logic, at pattern detection. It can beat us at chess, at Go. But if the AMH teaches us anything, it's that rational thought is just floating on a sea of emotion. So here's the final thought we want to leave you with.
We don't just need smarter algorithms. We need algorithms that have artificial humanity. Algorithms that actually understand our unique, evolved heuristics.
Imagine an algorithm that monitors your stress levels through your watch or your voice pitch. It predicts when you're about to hit the panic sell button because of loss aversion.
And it provides you with a running, customized narrative. The perfect story explaining exactly why, based on your own goals, you shouldn't do it.
The next great challenge isn't creating smarter AI. It's creating AI that understands and can protect us from our own predictable stupidity.